Welcome to this edition of Diligent Institute's Inside Today's Boardrooms. I'm TK Kerstetter, and I'll be your host for today's show. Today, we're going to be talking about what an institutional investor expects from today's corporate boards. And joining me to have that discussion is Michael Garland, who's the Assistant Controller for Corporate Governance and Responsible Investment at the New York City Office of the Controller, who I will make reference to as the New York City Pension Fund. So welcome to the show, Michael.
Thank you, TK. Happy to be here.
So the New York City Pension Funds has a history of being, as I should say, firm with some of their investors in the sense of what they feel is appropriate, governance attributes and capabilities. That was never clearer than when you guys pushed for proxy access in the past years, which has turned out to be sort of a valuable tool. And some people would call you an activist, or call the New York City Pension Funds, the Controller's Office, activist. But my history, Michael, is that you're just very concerned about what's happened versus really pushing for a company to, spin off something or sell itself or something like that. So before we get started, just talk a little bit about, how you view yourselves.
Rather than activists, I'd call ourselves, we're a very active owner to protect our long-term interests and sort of, to your particular area of interest, we're very focused on the board of directors. As a long-term investor, we have to rely on the directors we elect to act on our behalf. Given our investment strategy, which we're broadly diversified, if we don't like a board of directors, if we're concerned about a management team or a company's business practices, it's not easy for us to walk away. On some very specific circumstances, our trustees have decided to divest from some companies, particularly fossil fuel reserve owners and gun manufacturers. But for the rest of the portfolio, the only way for us to protect and create value is to actively engage our portfolio companies, starting with the board.
Well, and that makes perfect sense. If I was sitting on that side of the table. So that's a great segue. Board composition is a great segue to my first question for you. So what are the sort of the core expectations that you have for an invested company's board of directors? And I recognize that this is, we don't have a great deal of time, but when you start to look at a company that you invest in, what are those core expectations that you expect from the board?
When we look at a board, I think our views evolved over time. Historically, we've been very focused on director independence and accountability. But I think we're really moving to a place where we're much more focused on board composition and quality, which when I say board quality, I think that encompasses racial and gender diversity, as well as having the relevant skills and experience to oversee a company's long-term strategy and risks.
So, you hear a lot these days about ESG and all the other, buzz things. I'm sure you're concerned about cyber and what steps the company take. So how do you sort of, outside of just the board and the other governance issues, how do you sort of think through their expectations relative to all of the other issues that a board's dealing with?
I think we want to see boards have explicit oversight for material risks, including one area we're particularly focused is with respect to human capital management, meaning employees below the executive suite, to have embedded in a committee charter that the board has responsibility for oversight of company's workplace practices. We expect the board to set a strong tone at the top for ethical conduct and responsible business practices. And we do look at board independence, but ultimately what we want is the board to provide independent oversight in which they constructively scrutinize and challenge management. It'd be nice to be a fly on the wall. It's very difficult as an investor to know which directors are adding value in the boardroom. And we would like to get to a place where we're better equipped to make individual director assessments, which is difficult to do.
So when you, I know in the perfect world, you'd have the opportunity to engage with companies on a regular basis, but obviously with as broad as your portfolio is, that doesn't lend much help. So I assume you do what others do, and then you sort of look for areas where you must engage, to create change. But talk a little bit about when you do want to engage. What sort of signals would you take that says this is a company that I need to engage with?
Right. There are two ways that we can try and affect change. One is through our proxy voting. There are a number of red flags that will trigger an against vote against some or all directors. But we're also active engaging often through shareholder proposals. And if I look at the roughly 30 to 40 shareholder proposals we filed for the 2023 shareholder season, they are typically prompted by a company's failure to disclose director-specific race and gender, and also relevant skills and experience in a format that allows us to understand how the various directors fit together and provide the right mix of skills. Really a board matrix is what we like to see and have our proposals request. And then also file proposals at companies that have not, for high emitting companies that have failed to set science-based greenhouse gas reduction targets. And we have a number of other proposals out there this season that relate to either a company's human capital management practices or disclosures.
So I want to ask this. I think that this may be helpful to our viewing audience here. And this is sort of a reverse engineering of the question, but so feel free to repeat yourself if it's important. But I want to ask you, what within the governance structure, when you first look at a company, what's that most important red flag that you see that will spark, sort of moving somebody over to the column that says, I've got to, follow up on this and be very attentive because this doesn't look good to me?
Well, that kind of analysis, happens most frequently in the proxy voting process. We own roughly 3,000 U.S. companies, and we have an experienced team that looks at every single one of those when casting proxy votes. I was talking about this other day. Although I have been with the office for about 12 years, the proxy voters I oversee have each been there at least 16 years and collectively have 80 years of experience voting proxies for the New York City pension funds. And I'd say some of the most frequent triggers that can trigger an against vote is excessive executive compensation, which is a concern not only in and of itself, if it's misaligned with performance, it also can be a red flag that indicates that a board is an ostensibly independent board isn't actually acting independently to provide oversight. And then other, sort of objective triggers are inadequate racial and gender diversity, unilateral adoption of bylaws that weaken shareholder rights, and inadequate board refreshment or a lack of relevant director expertise.
So if you had to compare yourself to the larger institutional investors, the Vanguard, the State Street, or the BlackRock. How do you differ from those that really hold a pretty significant position in all U.S. public companies?
Well, although we think we're the fourth largest public pension system in the country, and we think of ourselves as a large investor, our ownership at a particular company never comes close to those investors. So they clearly have a louder voice than us. But I think that a key distinguishing factor is I think we're just more comfortable voting against management whether that's on the election of directors, for shareholder proposals or other management proposals. And we tend to vote against say on pay much more frequently than the large institutions. And when we vote against say on pay vote, we will also vote against the members of the compensation committee, because they're the ones ultimately accountable for a company's compensation practices. And the other distinguishing factor, which you alluded to a little bit, is we're a little bit more public in our perspective and our engagement activity, maybe because we're a public entity. And we pre-disclose all of our proxy votes on our website. Large institutions are now, if they manage a mutual fund, they are required to disclose, I think, as of August 30th for the prior year. But our votes are up on the website as soon as one of the team makes a decision and pulls the lever on the vote.
Well, Mike, I want to thank you for taking the time to be so candid with our viewing audience. You guys again have set the tone at times on having board of directors improve their performance in areas. And I think that you sort of shedding light on what's critical is helpful to anybody that's viewing the program. And I just want to thank you for, again, taking the time to join us and passing this wisdom along.
Thanks, TK. It's been a pleasure. One last thing, which I wish I had mentioned, given who I presume your audience may be. A key expectation of boards is that they will engage directly with shareholders. We've had companies in which it's been very difficult for us to get a meeting with a director.
Well, I would even at the level of my involvement in director education, I would say that no one should ever be shy about the idea of engaging with shareholders who, in theory, are the ones that they're representing in their responsibility of their position. So I can hardly argue with that thought, Michael. And again, thanks for taking the time to join us.
My pleasure. Thank you.
And that will conclude this edition of Diligent Institute's Inside Today's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.